countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Monday the 4th, 30 minutes to the European close. What do you need to know out of Europe this hour? Well, markets are down, but let's talk about politics. More spending means more taxes. The UK Chancellor says his government will not pursue reckless borrowing. But with the economy being hit hard by shortages and inflation, is growth already stalling? We're going to be live at the Conservative Party conference in just a moment. The energy crisis dominating today's EU finance ministers meeting. We're going to take you to Brussels with the latest on that. And IATA warning the airline industry will lose in excess of $200 billion as a result of the pandemic. That wipes out nearly a decade worth of profits. That's not great news for investors. Let's talk about where we are with equities. We're certainly seeing a sell-off stateside. It's gathering pace as well over here. We're only down by 0.3%. We are seeing significantly larger losses on the other side of the Atlantic. We are, though, continuing to see gas prices pushing higher, as you can see.
Yeah, Guy, it's really turning into quite a messy Monday from Mushy Monday. Part of it's going to be idiosyncratic. You have Facebook, for example, really weighing on the Nasdaq 100, the biggest loser of the day here, off by over 2 percentage points. Also, Moderna getting hit hard for a second day. That's really weighing on the Nasdaq 100. But the S&P also down, just dropping like a stone after the factory orders and capital goods orders, even though I didn't see anything in those numbers that would necessarily trigger more of a decline here. You have all the indices really in the red, with the exception of energy outperforming, as we have an $80 handle now on Brent. Energy index up by 1.6%. The only stocks in the S&P that are really green: Williams, Occidental, EOG, all of the shale players. 10-year yield, though, interesting here. The yield's up still by 2 basis points. It was up 4. We paired some of that, but you're still not seeing the safety kind of bid within the 10-year market that you would have thought. It now becomes a question of, do you buy the dip? What happens into the close? Will retail investors be there like they have in the past, or will it take a couple days to base around this potential sell-off, Guy? If government bonds don't balance your portfolio, if equities are going down, why do you want to have them within your portfolio? It's a key question that PMs continually ask themselves at the moment. I'm really looking forward to catching up with Luke Ellis from Man Group tomorrow to talk about that very subject. Let's stick with the energy theme, Alex's favourite, and what is happening with inflation. European, actually I think it's just Eurozone, but it could be European finance ministers meeting in Luxembourg amidst the worst energy crisis to hit Europe in years. France's Bruno Le Maire, Spain's Nadia Calvino, both calling for a coordinated response. They spoke on the sidelines of this meeting in Luxembourg.
What we see is an unprecedented spike in energy prices, which is due to different reasons, but which is very much linked to the evolution of energy prices in international markets. This is not an issue that we can tackle at national level. We think we need a European coordinated response.
We don't want to be dependent on the supplies coming from foreign countries. That's the key point. And that's at the core of the French model.
We have to work very carefully and fast, that the situation won't get that bad. Of course, we have to support the households to survive if the situation is changing like a crisis.
If we want to have electricity and electricity supplies without emitting more CO2, we strongly believe that the nuclear production is one of the key responses we could give to that situation.
We should react, but not overreact. Because we have a strategy which is essential for the future of our economies, not only for the life of the planet.
Let's get the latest now from Bloomberg's Maria today. She's on location at the event. Maria, a lot of words there about needing to deal with this issue. Is there going to be any coordination? And if so, how does that coordination work?
Well, you know, Guy, today clearly this is the topic. It's all about energy, and everyone concedes that this is going to be a rough winter for Europe. Now, it's interesting that when I spoke to Nadia Calviño, but when I also spoke to Le Maire, the French finance minister, they both said that domestic measures, and a number have already been taken to suppress the wholesale impact on the households' bills, would not suffice going into the winter, that the European Union needs to take a much bigger approach, whether this means buying perhaps in bulk or negotiating the contracts as one remains to be seen. But they made it clear that going forward, this is not just about domestic measures. It will have to be on a much bigger, perhaps EU 27 agreement. Now, as you know, the issue here is that European countries have different ways of conforming their energy market. They also have different ways in terms of the components that form their energy mix. And right there, Bruno Le Maire, of course, he was taking the opportunity to say that perhaps the French model offers the answer to the rest of the European Union, which is to feature nuclear energy much more highly on their own energy mix.
I can't imagine 27 nations trying to collectively negotiate buying LNG, for example. It sounds like a nightmare. Maria, thanks a lot. Bloomberg's Maria Tadeo. Thank you. All right, for a look at how all that's impacting European markets, right now I want to go to Esti Dweck, a Flowbank CIO. Esti, how do you position for possible inflation that isn't necessarily quickly transitory?
Well, that is the question, right? We've known for a while that inflation was going to be higher than expected for longer than expected. And this is just another layer that is going to extend the rise in inflation. Now, this does seem to be rather transitory in terms of the energy crisis, but you still want to look at it. So, you know, there's some areas of the market like energy that are benefiting. We've talked about energy, we've talked about material for a number of months already. So that's one area to look at. We've kept an eye on break-evens, of course. One of the better ways of having a little bit of a hedge for the bond side of your portfolio. But beyond that, I think it's just trying to look through some of the noise, some of these reactions, and just thinking through to what the growth outlook is going to be like, how different governments and central banks are going to react, and try to stay positioned as long as that outlook doesn't materially change.
How long do you think that's going to be? Maybe this is transitory, but we throw the word transitory around all the time. It's not defined. Transitory can last a while, and I'm wondering at what point investors are going to say, actually, yeah, maybe it's going to be something that we have to live with for a while. This may just be this winter when it comes to energy, but shortages of delivery drivers, shortages of materials, they feel much more permanent at this point. Certainly judging by sort of my own personal anecdotal experience, trying to talk to companies about when stuff is going to be available.
It is a concern, and obviously transitory is a number of months turning into quarters and not a question of the very short term. I do think that the zero COVID policy that we've seen across most of Asia has exacerbated some of these supply chain shortages. So as we continue to move on from the pandemic, these should start to ease and we should have an improvement. We also saw a much quicker rebound and recovery in terms of the global economy, and businesses just weren't prepared given how deep in the pandemic we were before that. So a number of different areas that, you know, the factors that are weighing in here. I think we do have to be prepared for this to last a little bit longer. But I'm not sure it really changes the growth outlook that much, which I think has actually been stronger than expected. And the recent economic data has shown that as well. And that means that the market picture in terms of equities and risk assets stays quite constructive.
Is that because the consumer demand and household balance sheets are still so good? Or is it because the supply shortage is indicative of sort of more consistent, stronger demand? What gives you that confidence?
It's a combination of both, but when you look at the trillions in excess savings in the US, when you see that we probably are going to end up with something between 2 and 3 trillion of additional spending, now obviously over 8 to 10 years, not on the scale as what we saw during the pandemic, but when you combine the bipartisan and the reconciliation infrastructure packages, we're going to have some support there. And we're seeing ongoing underlying consumer demand. So it's difficult to imagine a very negative growth scenario when you have so much cash and so much will to spend.
What is your attitude and what do you tell clients about having government bonds in their portfolio? If this transitory phase of inflation lasts a little longer than we expected, we are going to continue to find ourselves in a situation where these bonds just continue to make losses after losses after losses. It's been something that investors have had to deal with for a while, but it feels particularly kind of germane at the moment to talk about it, given the fact that we do have inflation spiking higher, the yields are picking up, but they're way below where inflation is.
Absolutely. And I think this is going to be a question for the next 5 or 10 years, right? When you have such low yields as a starting point, what do you do with your bond allocation? And for institutional investors, where bond holdings are a bigger portion, is going to be an even bigger conversation. I think some of it depends on how overweight or underweight you've been and for how long, how much pain you've taken already. It's difficult to not have any at all. But at the same time, if you're thinking within an asset allocation, it's clearly the asset that you want to be underweight in, and then probably favor credit or short duration credit to get the yield pickup instead.
Quick question before we go. Everyone's always still talking about going into the value trade. If you go value, you got to go into Europe. How sticky do you think that is?
I think we've seen the bulk of the catch-up for now, at least. As I said, I think if inflation stays higher and growth stays stronger, it means it can continue. But we probably don't see the strength of this reflation trade like we saw at the end of last year after the vaccine announcements. But I do think there's a bit more to run.
Esty, great stuff. Thank you very much indeed. Nice to have you on the show. Esty Dweck, Flowbank CIO. What do we got next? The Tory conference, the Tory party conference, the Conservative Party conference is officially underway. Barclays chief UK economist Fabrice Montagna breaking down the economic impact of what we're hearing from the conference and what we're seeing on the streets. This is Bloomberg.
Our recovery comes with a cost. Whilst I know tax rises are unpopular, I want tax cuts, but in order to do that, our public finances must be put back on a sustainable footing. The worst parts of politics are driven by fear. We will do whatever it takes. I remember over 5 years ago being told that if I backed Brexit, my political career would be over before it had even begun. Well, I put my principles first, and I always will. I believe in fiscal responsibility. Just borrowing more money is not just economically irresponsible, it is immoral.
Some are saying the UK is going back to the 70s, the late 1970s, 79, the winter of discontent, shortages on the streets, shortages at the forecourts. Rishi Sunak, in some ways, kind of talking about that era, talking about kind of what Thatcher delivered post-79 and her view on borrowing, her view on the economy, the complete supply-side shock she delivered to the UK economy. Let's go to the Tory Party conference, the Conservative Party conference in Manchester. Bloomberg's Tom Mackenzie has been covering the event all day. In some ways, Tom, that is what we heard from the Chancellor today. In terms of how it was received inside and outside the conference hall, walk us through the reaction.
Well, that divergence is really interesting, Guy. The Chancellor of the Exchequer, Rishi Sunak, received a standing ovation. The room was absolutely packed. And to some extent, he is trying to look through the challenges that the country faces now to the longer-term benefits that he says will come with Brexit and retooling the workforce here, building on what he describes as the success of keeping unemployment relatively low during the pandemic. All of this, of course, happening, and this is the dichotomy, given that in some parts of the country there is now a sense of crisis, of course. The second week where you have these fuel shortages, the military on the road trying to help deliver fuel to forecourts across the country. Some supermarket shelves are empty, energy prices, the hit to utility companies, but also to households as well. That is all very real, but here the focus is on trying to move forward. There were no major policies from the Chancellor of the Exchequer, but he did say that he wanted to ensure that Britain's finances got back onto a more sustainable footing. He said and pointed out that debt to GDP is close to 100%. We know that the economy is not back to pre-pandemic levels, and that will be something of a nod, not just to the party core here, but also to international investors who are concerned. And you're seeing that reflected in sterling. You have done in the last few weeks. Yields rising, inflation at the highest level in almost 9 years as well. So that nod to investors. And you also heard the Prime Minister as well in the last 24 hours. He's going to give the major set-piece speech, Prime Minister Boris Johnson, on Wednesday, but he was being quizzed about the cost, the labour shortages, the wages, and he said, look, we want to see an economy where there are higher wages and we have a higher skilled economy. That, again, is not looking at the short term, it's looking at longer term for the UK. But it's also a Prime Minister as well and a party that continues, despite all of these challenges, to poll significantly ahead of the Labour Party opposition, at least 8 points. And of course, they still have a thumping majority in the Houses of Parliament. By the way, we also spoke to the Trade Secretary. She said they have not ruled out eventually, longer term, getting a trade deal with the US. They hope to do that before 2024.
Hope being maybe the operative word there. Tom, thank you very much indeed. Great to see you sticking around for us at the Conservative Party conference. Let's stay with the UK economy. We welcome Fabrice Montagna, Barclays chief UK economist. Fabrice, the Chancellor wants to make sure that he can balance the books. What I'm wondering, though, is whether we're going to see the economy slow down sharply and make that even harder.
You're right. I mean, there are two ways to balance the books. Either you reduce the deficits or you inflate activity and GDP. And it seems that the UK here stands out in the path it has chosen for its public finance by, I mean, fair enough, we have to look through some of the rhetoric from the political meetings, obviously, but clearly the direction of travel here is to get a grip on spending, to reduce the footprint of the government in a way that other countries, and especially the main partners of the UK, are not doing, right? Europe is deploying quite an aggressive medium to long-term funding package for climate change transition, energy, etc., while the US as well is voting on that part of spending. And here we have a chancellor that basically what he says is that the government will retreat ever more in the years ahead and reduce the size of its footprint on the economy. So there is clearly a differentiating factor here that the UK seems to embrace relative to others.
Which at the same time, talking about sort of diverging a little bit here, the market's almost fully pricing in 3 rate hikes by the end of 2022. Yeah. How does that make sense?
Well, listen, we got a treasury that's very focused on fiscal sustainability, the risk to public finance, the necessity to have small deficits. And it seems that we have a central bank that's equally worried about its credibility, whether that's inflationary fighting credential or the value of the pound or whatever it is. So we get from the fiscal and the monetary signals that policymakers want to make a point that they are doing the right thing, the sustainable thing, the credible thing. And even if that means, coming across as really restrictive. I mean, if we might be facing a policy mix, both fiscal and monetary, that is restrictive in 2022 and 2023. It's hard to see how the economy is going to survive that one.
Absolutely. There are some that are starting to call for a recession in the UK. You have, as you say, potentially restrictive fiscal policy, restrictive monetary policy, and a restrictive supply side to the economy. The supply side of the economy is certainly suffering at the moment. What is happening with the fuel shortage may be a short-term phenomenon, but there are shortages kind of in many, many sectors across the UK economy. Can you walk me through what impact all of these factors could have on GDP over the next 12, 18, 24 months?
Well, I can make that easy for you. There's none of the shocks that you mentioned that is GDP enhancing. All of them are a drag on GDP. Some of them might be a drag on inflation. So we have to look at whether there's good inflation in there. But even that, it doesn't seem to be really good inflation whenever we're talking about supply side shocks or energy. So it is a wall of worries, rolling towards the UK. And you know, we hear a lot of these kind of fiscal and monetary restraint or restrictive approach from countries that are unsure about the credibility and the status, right, in the global economy. And usually the collateral victim here is GDP or high unemployment. So I think the paradox of all this is that the UK doesn't have a problem of sustainability. The Bank of England, I don't think, has a problem of credibility in fighting inflation. And still, we hear a lot of that rhetoric coming from the Treasury on one side, the Bank of England on the other side. And, you know, it's less about what I think will happen than what those guys will do. And it seems that it seems restrictive on both ends.
So do you feel like the FX market, for example, where the bond market has priced for this kind of scenario?
It is hesitating. And to be honest, you know, I updated last week a chart I did for the 2016 Conservative Party conference. I don't know if you remember, but back then the motto was no deal is better than a bad deal. And back then the market, you know, hesitated and priced something that looked like a country risk premium, meaning that asset prices went down, rates went up. And last week, for a couple of days, we had the same kind of dynamic where the pound went lower, domestic equities underperformed, and rates shot up, right? It's never that clear cut. So there's always a balancing effect in the UK because you always have investors ready to step in and you know, to some extent buy the pound because, you know, there's the split belief out there that after all, the UK is still a good place to invest. So it's never as clear cut as an emerging country. And also because the UK doesn't really share all the features of an emerging country. Let's be clear about that. But yes, to answer your question, the market sometimes hesitates, right, to trade the UK in a much more volatile way than other developed markets.
Really interesting, so insightful. Thank you so much, Fabrice Montagna of Barclays. Thank you. We're just about 7 minutes until the close of trading over in Europe. This is Bloomberg.
Four minutes to the close. How do European markets look? Well, not as bad as they do over in the United States when it comes to an equity story. The FTSE 100 is only down by 0.1%. Energy stocks and mining stocks are outperforming today. They're both on the upside. They're both in the green. That's why London's doing a little bit better. DAX, though, is down by 0.7%. The CAC 40 over in Paris is down by around 0.5%. In terms of the sector breakdown, technology is actually something of a laggard today. That certainly gels with what we're seeing stateside, doesn't it? With the Nasdaq very much under pressure. So there's a little bit of read across, but it's the energy story on both sides of the Atlantic that is proving to be the big driver. We've got Brent north of 80. We've got TI moving up through the 70, 75 level, 75 and more. This on the back of what is happening with OPEC. What are we going to do next? Well, we're going to do the close next. We're also going to talk about what's happening in the aviation sector. The IATA meeting is taking place in Boston. We're talking about huge losses for this sector. What message does that send to the investments sector? John Strickland, JLS, is going to be joining us to talk about that. So we're coming into the close here in Europe. The auction still to go, but nevertheless, things aren't looking particularly pretty here, but they are looking better than they are over in the United States. Technology is the lagger. It's certainly having a big effect on the DAX today. Names like Infineon and Delivery Hero certainly acting as a bit of a break on that market, which is down by around 0.7%. The CAC's down around 0.6. The FTSE 100, though, fairly flat today. The reason for that? Energy stocks are doing fairly well. We're seeing, as I'll show you in just a moment, Brent crude, TI both moving up very nicely. That's feeding back. Plus, also the mining stocks are doing relatively well as well. That's insulating the FTSE from the wider market mayhem that we're seeing today. Let's show you what's happening in terms of the session, just to give you an idea of how we progress today. We've certainly been rolling over quite sharply over in the United States, and you can see the effects of that towards the back end of the session here in Europe. That's the move we're getting out of the S&P and the Nasdaq in particular. For most of the day, though, we've really just been tracking sideways, but not down by that much. But we are right on the precipice of that 450 line. Could have a 440 handle fairly shortly, 449. We're not that far away. We'll see what the track is tomorrow. In terms of kind of assets that are affecting the narrative, the pound actually responding fairly well today. It's a broad dollar weakness, but 136 retaken. We've seen an earlier move in UK nat gas fade, so that's coming off, but we are seeing Brent crude very well bid at the moment, as you can see. We're north of 80, 81.60 on the back of what is happening with OPEC today, just providing a further catalyst. You do wonder whether the cartel will come under pressure in terms of pumping more and pushing prices down. Let's work our way through what else is happening. So we've got the sector breakdown. I can kind of give you an idea of what is going on here, but I think I've probably largely already told you. Energy, basic resources, the telecom sector actually looking fairly healthy today. Food and beverage, kind of the staples doing okay. Healthcare, fairly flat. Bottom end of the market, technology, travel, the industrial sector, that is where the weakness is to be found. I mentioned the telecom sector because actually BT Group is tracking lower today by nearly 5%. Looks like it could be getting some more competition in the UK market in terms of the fibre rollout. You could potentially be seeing Sky hooking up with the O2 network. It's all going to get interesting, but I think basically we don't know which way the permutations are going to end up becoming reality. But the potential for consolidation within the media/telecom sector within the UK looks like it is growing, and that could weigh on BT Group. Morrisons Supermarket, CD&R won the bid over the weekend, but actually I think the market was quite unimpressed by what it got from that auction, and as a result of which Morrison is tracking lower. Look for Tesco later on this week. The UK supermarket sector is getting super interesting right now because of the shortages that we're seeing, because of the competition, therefore, there is for assets like truck drivers ahead of Christmas. And also there's this talk that was mentioned in, I think it was the Sunday Times, I may have the paper wrong, but one of the UK papers over the weekend talking about a bigger return for shareholders for Tesco shareholders from the company. The airline sector broadly positive today. We've got the IATA event taking place over in Boston. I'm not sure the Ryanair is a member, but nevertheless, its stock tracking up by 2.21%, Alex. The airline sector, though, continues to have a really torrid time. It's better where you are than it is over here. In Asia, it continues to be incredibly tough.
Yeah, and that's just you basically saying that you're still bitter that you couldn't get to Boston for that airline conference. But losses can be significant. So the overall losses for airlines from the coronavirus pandemic could top $200 billion. That's according to IATA, the industry's main lobby. Joining us now for more, John Strickland, a JLS consulting aviation analyst. $200 billion. I mean, that's going to wipe out years of profits for these guys. When do we have a complete picture of how bad it's going to be, like when that bottom is actually going to hit?
Well, hopefully we have already reached the bottom, and that figure, although it sounds pretty scary and hairy, it is a relative improvement on the previous year. We've seen some improvement in traffic this year, not least where you are, the US domestic market, and other strong domestic markets such as China and Russia have been much more buoyant. We've seen in Europe some recovery of late season leisure traffic, and of course we're waiting at the moment with bated breath, hopefully for the reopening in early November of the very important long-haul transatlantic market, so between Europe and the US, and similarly some good news about Australia opening up later in the year as well. But the experience by airline varies very much according to the circumstances of each one you look at. Those who are exposed to long haul have had the hardest hit because there's been so little long haul flying. Certainly for passenger traffic, there's been some cargo, thankfully, to slightly offset those losses. Short haul carriers are those exposed to domestic markets who've done relatively better.
John, I know you don't cover the airline sector from an investment point of view. Good afternoon, it's Guy. But nevertheless, this is 10 years worth of profits that have been wiped out during the pandemic. What message does that send about the economics surrounding this sector, particularly as we are going to continue to have to deal with the pandemic fallout? We're going to have to continue to deal with the green energy transition. We don't know what that's going to mean. How solid a footing is this sector on from an investment point of view?
Well, I think you're right to point that out, Guy. I mean, it's long been a fragile sector. If we think now, Willie Walsh, of course, is heading up IATA. The last airline group where he was CEO was IAG, one of the much better placed airline groupings who had weathered a number of storms pre-pandemic, as have the large American network groups. And you mentioned Ryanair, Wizz Air, EasyJet, similarly these low-cost groups in Europe. They had learned lessons over the years in very good husbanding of cash, very close and scrupulous cost management. But I think it's fair to say that is not broadly adopted industry-wide. There are other good players as well, and I should mention certainly lessons learned in groups like Air France, KLM and Lufthansa too. But around the world, we still have many airlines that arguably should not exist, that are only there for political or government-sponsored reasons, or those who are in much more difficult segments. Certainly smaller airlines in markets such as regional flying always have a tough time. And it's a sector which is prone to government taxation and now, understandably, is also, as you said, in the spotlight for its credentials concerning the environment, which is going to bring issues, again, of cost and credibility that the industry has to address.
It feels like it's easy to look at sort of the government bailouts that we've seen of the airlines as a COVID thing, and that hopefully they can start making their own money and then pay back and then it'll be fine. But I wonder, to pivot off of Guy's point, as we transition in the green energy world where sustainable aviation fuel is by no means prevalent, and at some point we're going to need new types of planes for these carriers to fly, is this sort of nationalization of the airline industry something that's just going to kind of keep rolling on and kind of keep happening?
Well, it simply can't roll on because of what we've been seeing this year. There's been many very visual examples of impacts of climate change across the globe this year in particular. And I think we'll hear quite a lot of discussion in the course of this next 2 days at the IATA event, the seriousness with which the industry is taking this. I recall attending one of IAG's capital market days when Willie was at the helm, and I remember clearly that he took that baton, so to speak, on the environmental issue for IAG when he was leading that company, and he's certainly taking that as a serious priority now, equal to COVID. He's not seeing that COVID is an excuse to allow this to be pushed back. But as you said, although there are new technologies such as hydrogen and electrics, they're such a long way down the line. I'm talking about decades and a lot of research. We've got to start doing practical things now, like better air traffic management and the use of these sustainable aviation fuels, which can be put straight onto current aircraft.
They can, but we don't have the capacity to do that from a production point of view at this stage, John,
absolutely.
and we are years away from making that happen. So in the meantime, we've nationalised Lufthansa, we've effectively nationalised Air France. In reality, this is what has happened. What does Europe need to do in particular? It hasn't had the consolidation that we've seen over in the United States. Can it build balance sheets? Can the European aviation sector build its balance sheets back to put them on a stable footing at the same time as making the energy transition, at the same time as allowing these airlines to exit from effective nationalisation?
It's a very big ask, but of course there is no choice. If we look at a couple of those airlines, certainly IAG has managed to avoid taking government funding. Here in Europe is still very much relying on its own resources and already was, I would say, leading the European pack on the green agenda. We look at Lufthansa, which, yes, has taken quite a chunk of government funding, not only from Germany, but from other countries in which it has airline stakes. But certainly Carsten Spohr has been at pains to start paying that back. Lufthansa has just done a big rights issue with that in mind. Air France, KLM, a bit different, perhaps a bit more murky, particularly on the French side, as to how much government is going to stay involved with that airline group, having put funding in, particularly the French government in recent times, and putting environmental stipulations into that funding too. So I think it's a mixed picture in terms of airline freedoms, but the intentions are there in those groups. And of course, the low-cost carriers are out there. EasyJet, again, having just had a successful rights issue at Ryanair and Wizz Air, very cash flush, relatively speaking, given the depth of the crisis we find. We're seeing new aircraft coming in, current generation aircraft, which are more fuel efficient, such as the 737 MAX in the case of Ryanair, or A320 Neo family in the case of other airlines like Wizz Air. But we need to see a much more cooperative and collaborative approach from governments. I think this is a message that we'll hear from Willie Walsh, pushing governments. They can't just tax the industry. That's not the right way to help it succeed. We need a lot of investment to speed up the whole process, as you said, a long way into the future for those new technologies. And the sector can't fund that all on its own.
John, always a pleasure. Nice to speak with you. Thank you very much indeed. John Strickland, JLS Consulting Aviation Analyst. Quick look at where European markets have wrapped up the day. As I say, the FTSE 100 faring a little bit better. We're still flirting with that 7,000 level. The miners, the energy stocks doing a little bit better there. We ticked lower during the auction. We're only 11 points above that. The DAX being hit by some technology names. The CAC down by 0.6%. Alex.
Yep, Guy, here in the U.S., we're waiting for President Biden to speak on the debt limit any moment now. I want to bring in Mario Parker, Bloomberg Politics team leader, here with us. Hey, Mario, what are we expecting President Biden to do? Who's he talking to? What's the pitch?
Well, President Biden is making his pitch to the American people to ask for help to pressure some sort of bipartisanship here in Washington between the parties who are right now, Alex, engaged in a very dangerous game of chicken.
In terms of the dates that we have on the agenda, we're trying to figure out exactly kind of which is the one that we need to be focusing on. Halloween seems to be emerging now as a key line in the sand. Give us the kind of schedule that we're working with here.
No, absolutely. I think the median and the safe pick, as you mentioned, is Halloween now for a deadline. Prospects for a default range anywhere between October 18th, give a week or two or so in terms of projections as to when the U.S. would hit that. So Halloween is now the big date. But however, Chuck Schumer this morning is out with a letter to his colleagues, his caucus, saying that the time is of the essence, that he's be prepared to work throughout this weekend as well to get something to the president's desk.
We heard earlier today that Senator Mitch McConnell told President Joe Biden that he should pressure the Democratic leaders in Congress to go ahead and raise the debt ceiling limit because the GOP just will not cooperate. Now, the Democrats have made it very clear they want it to be a bipartisan vote on this, saying that the Republicans are in part responsible for racking up this debt. They have to be responsible for raising the ceiling. Which way do you think the pendulum's going to wind up swinging and landing?
Well, as of right now, Republicans are betting that the party in power, which are the Democrats at this point, would be the one to receive most of the blame, regardless of whether, it's the debt ceiling has been something accomplished through bipartisan measures in the past. In the letter that you mentioned, Senator McConnell also flicked at President Biden's time in the Senate as well, saying that when George W. Bush was president, the now president Joe Biden didn't support Republicans in raising the debt ceiling.
Gets thicker and thicker. Mario, thank you very much indeed. Thank you very much for the time and the continuing reporting. Mario Parker joining us, Bloomberg Politics team leader. It seems the president may still be a few minutes away. When he speaks, of course, we will bring you his comments. This is Bloomberg.
Congress, what they're doing today is so reckless and dangerous in my view. Raising the debt limit comes down to paying what we already owe, what has already been acquired, not anything new. It starts with a simple truth. The United States is a nation that pays its bills and always has. From its inception, we have never defaulted. What we pay for, so it keeps us a great nation. Social Security benefits for seniors, salaries for brave service members, and benefits for veterans, and other financial obligations for our people and for our nation. We're able to meet these obligations based on the revenue we receive from taxes and based on our ability to borrow when needed. And in that case, we're able to borrow because we always pay our debt. We always paid what we owe. We've never failed. That's America. That's who we are. That's what's called for. It's called full faith and credit of the United States. It's rock solid. It's the best in the world. But here's the deal. There's a cap on what we can borrow called the debt limit. And only Congress can raise or lower that debt limit. So let me be really clear. This is really important to know. Raising the debt limit is about paying off our old debts. There's nothing to do with any new spending being considered. There's nothing to do with my plan for infrastructure or Building Back Better? Zero. Zero. Both of which, I might add, are paid for. So if we're going to make good on what's already been approved by previous Congresses and previous presidents and parties, we have to pay for it. Social Security benefits, the American people are promised, salaries for servicemen and women, benefits for veterans. We're going to have to raise the debt limit if we're going to meet those obligations. And raising the debt limit is usually a bipartisan undertaking, and it should be. That's what is not happening today. The reason we have to raise the debt limit is in part because of the reckless tax and spending policies under the previous Trump administration. In 4 years, they incurred nearly $8 trillion. In 4 years, $8 trillion in additional debt. In bills we have to now pay off. That's more than a quarter of the entire debt incurred now outstanding after more than 200 years. And Republicans in Congress raised the debt 3 times when Donald Trump was president, and each time with Democrat support. But now they won't raise it, even though they're responsible for more than $8 trillion in bills incurred in 4 years under the previous administration. That's what we'd be paying off. They won't raise it, even though defaulting on the debt would lead to a self-inflicted wound that takes our economy over a cliff and risks jobs and retirement savings, Social Security benefits, salaries for service members, benefits for veterans, and so much more. A failure to raise the debt limit will call into question Congress's willingness to meet our obligations that we've already incurred. Not new ones, we've already incurred. This is going to undermine the safety of U.S. Treasury securities, and it will threaten the reserve status of the dollar as the world's currency that the world relies on. American credit rating will be downgraded. Interest rates will rise for mortgages, auto loans, credit cards, borrowing. Folks watching at home, you should know this is the Republican position. Here's it is. They won't vote to raise the debt limit to cover their own spending. Democrats voted with them to cover that spending the previous 4 years. They say Democrats should do it alone. But then they're threatening to use a procedural power called the filibuster, meaning that we'd have to get 60 votes, not 50 votes, to increase the debt limit. This would block the Democrats from meeting our obligations and responsibilities to prevent Congress from raising the debt limit. So let's be clear. Not only are Republicans refusing to do their job, they're threatening to use their power, to prevent us from doing our job, saving the economy from a catastrophic event. I think, quite frankly, it's hypocritical, dangerous, and disgraceful. Their obstruction and irresponsibility knows absolutely no bounds, especially as we're clawing our way out of this pandemic. Democrats will meet our responsibility and obligation to this country. We're not expecting Republicans to do their part. They made it clear from the beginning. We tried asking to no avail. We're just asking them not to use procedural tricks to block us from doing the job that they won't do. Meteor is headed to crash into our economy. Democrats are willing to do all the work stopping it. Republicans just have to let us do our job. Just get out of the way. If you don't want to help save the country, get out of the way so you don't destroy it. We don't have time to delay with elaborate procedural schemes, which Republicans' proposals require. Scores of votes without any certainty at all, many of which have nothing to do with the debt limit at all. And that's when accidents happen. In the days ahead, even before the default date, people may see the value of their retirement accounts shrink. They may see interest rates go up, which will ultimately raise their mortgage payments and car payments. And the American people, look, I just say it this way. As soon as this week, your savings in your pocketbook could be directly impacted by this Republican stunt. It's as simple as that. Republicans say they will not do their part to avoid this needless calamity. So be it. But they need to stop playing Russian roulette with the U.S. economy. It's one thing to pay our debts already acquired. It's another to require a supermajority to pay the debts already acquired. It's not right. Let the Democrats vote to raise the debt ceiling this week without obstruction or further delays. Democrats in the House have already passed a bill that would do that. It's sitting in the United States Senate where Democrats have the votes ready to pass it. That's the only way to eliminate the uncertainty and risk that's going to harm American families and our economy. Let us vote and end the mess. You know, we've got to get this done. We must get this done. It is, like, as I said, playing Russian roulette to play these games. We can do it this week. Just get out of the way and let us pass it. Thank you.
Mr. President, Senator Mitch McConnell says he has sent a letter to you explaining his view. Have you seen that letter? Have you communicated with him? And how dire do you believe this is if action doesn't take place in the next few days?
First of all, I did get a letter. I got it 10 minutes before I walked in here. I've read it. I plan on talking to Mitch about it. He and I have been down this road once before, back when I was vice president. And I hope we can have some intelligent and honest conversation about what he's proposing. And I think the easiest way to do this, and if the Republicans would not use the filibuster, would be to let us vote on what is already in the Senate right now, passed by the House, to raise the debt limit. And we could do that in the next several days.
Mr. President. Thank you, Mr. President. You've often touted your experience in the Senate, your 36 years in the Senate. Your aides have talked about your abilities to be a closer on deals involving legislation. Why were you unable, Mr. President, to close the deal with members of your own party on key parts of your legislative agenda last week? Thank you.
I've been able to close a deal on 99% of my party. Two people. That's still underway. I don't think there's been a president who's been able to close deals that's been in a position where he has only 50 votes in the Senate and a bare majority in the House. This is a process. We'll get it done.
It sounds like you're putting the blame squarely on two U.S. senators for your inability to close that deal, Senator Sinema and Senator Manchin. Am I incorrect? Is that who the blame lies with?
Look, I need 50 votes in the Senate. I have 48.
Leader Schumer has vowed not to raise the debt ceiling through the reconciliation process. So ultimately, if push comes to shove, Leader Schumer has said he won't raise the debt ceiling through the reconciliation process. So ultimately, if push comes to shove and Senator McConnell does not change his position, what is more important, that position that Senator Schumer has or raising the debt ceiling? And then I also have a question for you on Ethiopia.
No, I'm going to answer one. I'm not going to answer Ethiopia. Let's stick on the debt so we don't confuse the American people. Number one, the issue of reconciliation, which is like code to the American people. What's reconciliation? There is a process that I understand the Republican leader is willing to initiate, go through, that would require literally up to hundreds of votes. It's unlimited number of votes having nothing directly to do with the debt limit. Could be everything from Ethiopia to anything else that has nothing to do with the debt limit. And it's fraught with all kinds of potential danger for miscalculation. And it would have to happen twice. So you could literally have several hundred votes over the next number of days. Everything else would come to a standstill, but you still find yourself in a situation where at the end of the day, we may have passed something that in fact then has to be undone again by either Democrats or Republicans. It's an incredibly complicated, cumbersome process when there's a very simple process sitting out there. Sitting at the desk in the United States Senate is a bill passed by the House saying we Democrats We'll raise the debt limit, take responsibility for raising, even though we didn't, some voted to acquire the debt as well. We'll go ahead and do that. That's the way to proceed.
If it comes down to reconciliation or raising the debt ceiling, which position would you take?
I'm not going to cross that bridge till we have to get there.
Would you address the allegations of genocide and why you haven't yet imposed those sanctions that you authorized?